Hello everyone, a very good morning, good afternoon and good evening to all. Myself Vaibhav. In today's session of automated trading, we are going to look at the possibility of using different lot sizes depending on the volatility of the underlying instrument. This is not a new algorithm session. We are just continuing to work with what we finished yesterday. So the underlying algorithm, the basic on the algorithm will be the same, only at the end when we are done with all the condition checking, and now that we are ready to go in for the execution. Once again, we will take a look on the underlying instruments volatility and see that what kind of lot size will be appropriate in the given circumstances. So we are just going to use multiple orders and do some modifications. I hope you are well familiar with the Williams-Sars functionality, as we have done a couple of sessions earlier as well. And then ATR is going to be of a lot of use for us. Before we go into the detail, this is a standard disclaimer, as I would like to remind you that this session is simply for the tutorial purpose and no claim is being made regarding the profitability or otherwise of the algorithm which we will be developing during the session. Suppose if you want to use any of it, I would recommend that you do extensive trial runs for many months and maybe even years to get a clear-cut idea of the efficiency of the algorithms developed here, and nothing in the webinar is to be constructed as an advice to trade or for any particular setup. On that note, we get started for our day. So here I would explain to you on the chart. See, even if the instrument is the same, its volatility keeps varying from time to time. So for the day, the ATR is of around 116 pips. We go back a couple of weeks, say 2 weeks, and here we have the volatility above 150 pips. Then we again go back. Here you can see the volatility is around 9700 pips, and then we go back in the early part of the in the February, middle of the February, and we have volatility which is even below 50 pips. So as you can see that these things keep varying depending on what's happening in the broader world, and then we have to make fresh assessment and trade accordingly. That's why we have been using the dynamic profit loss ratio. So we are simply utilizing the ATR, and then we are keeping our stop losses and the target price dynamic. We can also try that same thing with the lot size. We can even make it dynamic, but the issue is that since we are varying the length of the target price and the stop loss, it will kind of get complicated. So for today's session, we are going to simply keep it in multiples of say 50-60 pips. So only then, suppose if we are going in for a one lot size say of 0.2 to 1 million till 50 pips, then we can reduce maybe one third or reduce it by one third or one half when the volatility goes beyond that, and maybe for till 100 pips we can keep that lot size, and then after 100 pips we can reduce it again. So you have to calculate what is your risk profile. Suppose if you want to limit your risk to say $100 or $200 per trade, and then you have to keep in mind also the target price, as it is most probably we go with a conservative stop loss target ratio of say 1 is to 2. So suppose if your risk is of 200 USDs, then you will be keeping your target price of around 400 USD, and so the lot size will be need to be kept in proportion of that. Suppose even if the volatility goes up, our risk profile shouldn't change. Our risk should be almost at the to the closest possible interval. It should be in the vicinity of that. We can't be exactly dynamic, as we are simply utilizing a simple setup. Maybe someday later on we will also try to keep it make it better dynamic, and it will be varying from pips to pips, but for today's session we are not going to do that. So let's get back to the work. I hope you are well familiar with this setup which we finished yesterday. So here is simply the instrument subscription. Then we were utilizing the Williams-Sonn values, shift 1 and shift 6, to look back on the overbought oversold conditions. Then we utilized these historical candles from shift 1 to shift 5 to check on the price action in the recent past. Then we utilized the ATR values of the yesterday to measure the volatility prevalent in the underlying instrument. Then we did these calculations, the difference between the closing candles to see that there should be at least some volatility, and we have defined the measure as well. Then we got this 10 seconds candle just for the execution purposes. Then we defined this buy execution price and the sell execution price by adding or subtracting the appropriate level of the ATR from the last candle close. Then we made this stop loss and the target prices dynamic using this calculation, and then the type conversion from double to the integer type. Then here we have defined these candle open and candle closing conditions. So we will not go into the details. Then we got this Williams-Sonn condition. Then the buy candle difference is needed to be more than the 100% of the ATR, and then we simply look at the price action. Whenever the price starts to rise above the buy execution price, the system will execute the buy order. And here also the symmetrical, it is almost symmetrical, almost you can say it is totally symmetrical, as we are simply inverting the conditions and going in for a sell trade. So this everything remains the same. What we are going to do in today's trading session, we will be simply looking at the ATR values. So we take if blocks, and we will use three variables. So we will take three if blocks for the buy side and three if blocks for the sell side, and we will need to bring in two more open at market as we have already one, and then we will need to compare those conditions and then going for a fresh trade. So first of all, we will add these blocks on the sell side. So we take the ATR value and then we compare it to for this particular session we are going to use the interval of 60 pips. So first we will keep it for 0 to 60, then from 60 to 120, and then from 120 to 180, and we will cap it at 180. Of course you can vary it depending on your preference. You can even use more than 3 intervals or less than 3 intervals, so it's not an issue. So let's go back on the chart to, so here we will be checking the yesterday's value. So suppose if we are going to trade today, we will be taking a look on the yesterday's ATR value. As you can see, it is 121 pips here, and then the order execution block in the interval of 120 to 180 should come into play, and that lot size, the order with the defined lot size should be placed. So that's the whole idea is about. So we go for we will need to define values for 60 pips. We will have to keep it like 0.006. For 120 pips it will be 0.012, and for 180 pips it will be 0.018. So again we go back and we write it. First interval is 0.006, second interval is 0.012, third interval is 0.018, All right, we got it. So keep a watch on these decimal points because Euro USD has 4 decimal points till the last beat, and so we have to be kind of bit careful. We are going in for open at market. We will need two open at market. We have one already in the system. We add two more, and then we need this to be on the sell side. Okay, both of these. We first of all make changes in the combination of the stop loss and the target. So here we will change the slippage as well. Let us go for a slippage of 2 pips. 2 pips is good enough for the Euro USD, as the Euro USD slippage spread is pretty tight given the fact that Euro is a widely traded currency. Now we will use, for the simplicity of the explanation, we will use the combination of 0.3 million, 0.2 million and 0.1 million. Whenever the volatility is less than 60 pips, our system will place the order of 0.3 million. Whenever the volatility is between 0.006, that is between 60 pips to 120 pips, then the system will place the order of 0.2 million. And whenever the volatility is more than 120 pips to 180 pips, it will place an order of 0.1 million. So we use three combinations, 0.3, and then comes 0.2. Okay, default instrument remains the same. We change the stop loss. The stop loss is defined here, the SLP, and we change this one as well. We change the take profit as well. We are not going in for a fixed take profit. We have kept it dynamic. Now it's time to go back and add this lot size changes to the algorithm. Then we will add the same setup for the sales buy side as well. This is for the sell side. These changes are for the sell side. So here we are almost reaching where we need to be. So 0.1 million lot size will be kept reserved when the volatility shoots up beyond 120 pips. First we will go for 60 pips, then 120 pips, and then comes 180 pips. And here we are going to keep rest of the conditions as it is. So we want candle close to have been less than the SCP, so we keep it as it is. Now here comes when the volatility is less, we will be going in with a more lot size. and we will be utilizing 0.3 million. So whenever it is less than or equals to, so the 0.3 million would be our lot size. If the ATR is above 60 pips, then we will check if it is below 120 pips. If it is below 120 pips, then the lot size will be of 0.2 million. So between 60 pips to the 120 pips, the lot size will remain at 0.2 million. So we make it like this, less than or equals to, and then if it is greater, then we check if it is below 180 pips. If it is below 180 pips or equals to 180 pips, then we will execute the orders with 0.1 million lot size, and if it is beyond 180 pips, no order would be placed. It's not like you can't trade above 180, you can also trade above, but it is simply for the explanation purpose I have made this. You can reduce the lot size further and then place the order as well, even if it is above 180 pips. So I hope you are able to understand what we have done on the sell side. Now we have to do same thing for the buy side, and again we take 3 if conditions, and we take 2 market open blocks, and then we do the necessary changes. Open at market. Now we take ATR value of yesterday, daily shift 1, and then we compare the ATR value to the current value 0.00660 pips, and here it should be 0.012 120 pips, and it is 0.018 180 pips. So coming to this particular setup, now trade amount, which will be defining at the 0.3 million and 0.2 million. We have one more block of 0.1 million already. Slippage will be kept at 2 pips. And here we got 2 pips. Now we change the static stop loss and the target price combination and make it dynamic. So we take the calculation from these SLP and the TPP. So we remove this default stop loss, default take profit, and we bring in the SLP and the TPP, and here comes the stop loss removal. Here also again we remove that, and comes the TPP in place, and here comes the SLP. So these changes we need it on the buy side, and now we are going to attach these modifications to our earlier algorithm. So here now we need to add these requirements, and we keep rest of the conditions the same, no changes there. Candle close should be less, so it should be less. Okay, so we add it here, and we reduce it here, and we add 180 pips. Now if the ATR is less than 60 pips, then we will go in with a larger lot size. Then if it is more than more than 60 pips but less than 120, then we will use 0.2 million as our lot size. So we connect this here, should be equals to or less than, and now it is greater than first input, greater than second input. If it is ATR is more than 60 pips, then we will check whether it is below or equals to 120 pips. If it is, then we will look for the execution with the lot size of 0.2 million. And then if it is more than 120 pips, then we will check if it is below or equals to 180 pips, and we will further reduce the lot size. So we take this as it is, and we utilize these values. Okay, so these are all the changes we needed to make our algorithm trade according to the underlying instrument's volatility. So it looks good to me. Let's do a short test run. Yesterday we had done the test run for the almost 3 weeks of March. No trade was executed actually. So we will try our luck on the different time frame today. Save the draft as APR9. Okay, and we save it. We now export the file in Java. Okay, we are not likely to get instant confirmation if the strategy is working or not, as we can't test it for too much of a time, maybe a day or two is all we can test it for. So we will go back on chart and see where there is a possibility of a trade execution, and we will test on that time only, just for the example purposes. You should test it for all the time, at least more than 6 months should be good enough. We now save it here, April 9th, APR 9th. Okay, we have saved it. Now is the time to export the same file, import the same file in this JForex platform. So we import it. This PC and comes webs is my name. We got to go to the tech folder is also having other things, so we go back on 2020 April and we look for the APR 9th. So here we got that, and let us see the code is almost more than 1100 lines. We compile it first and hopefully the compilation will be successful. Compilation is successful. Now let us take example on the charts where we see there will be a high probability of order execution, and we will get to know if our algorithm is trading well or not. So that's the reason. Now coming to I think we should try our luck somewhere here. What is the date? Date is 27th of February. So we test it for 27th of February for a day or two. We can't really spend too much of time on the test run. But of course, you should spend a lot of time on the test run to see if any idea is successful or not, unless we test enough, as is the case with the current pandemic. The mantra should always be test, test, test. More the test, better it gets. So we should be doing a lot of testing. All fine. We go in for a custom setup, and in the custom setup we put in 27th of February to 28th of February. Okay, good to go. Two pips, and here the lot size is, we don't need to make any changes in stop loss or the take profit. It should be good as it is. And here we add the equity chart. Now it should start testing. Most probably, even if this order gets executed, I think it is more likely to end up in loss unless there is any trailing step setup. So in the absence of trailing setup, it might go in for a loss only. Still, let's see. We are more concerned with how the algorithm is trading and if it is executing the orders right or not. So here we have got no trade so far, and no trading will be happening most probably by even the 28th of February. So we are done with the test run also for 2 days. We have tested and no trade got executed during the defined time. This is the report. No orders were placed, no positions were open. But I would recommend that you do test for a long enough time and see how the trades are executing and how, and if you do need to make any optimization, further optimization and the changes to make it more efficient. So I would like to thank you all for joining in. It was pleasure discussing these algorithm setup with you guys. See you not tomorrow, on Monday. It's Friday. Have an excellent weekend ahead. Goodbye.